I think the dollar will do well relative to other currencies, but I think the dollar will do very poorly in isolation. Let's look at the arithmetic around the U.S. 10-year Treasury, Patrick, in answer to your question. The Treasury pays you 4.4%. And if you believe the CPI stated rate of inflation at 2.6, you're getting a 2.2% real yield. Not great, not bad. You know you're going to get paid, because if they need to, they can print to pay you. But if you change your inflation assumptions to reflect real arithmetic, what you see then is that the purchasing power of your yield and your principal is declining by 7.5% compounded. Now that's brand new arithmetic. If you take 4.4 as the interest number and you subtract 7.5, the deterioration in the purchasing power, what you learn is that in a real sense, you're losing 3% a year, every year for 10 years. The U.S. government is making you a promise, Patrick. If you lend them $1,000 today in a U.S. 10-year Treasury, they will give you back 35% less purchasing power 10 years from now, and they guarantee it. Let's look at history and arithmetic. In the decade of the 1970s, with the U.S. dollar losing 75% of its purchasing power, the gold price went from $35 to $850, a 30-fold increase. Let's strip part of that out, just for fun. Let's say that the move from $35 to $100 was due to the legalization of gold ownership, because gold had been price controlled for 40 years? So let's say at the beginning of the decade, just for fun, that gold was $100 an ounce. At the end of the decade, with a 75% deterioration in the purchasing power of the US dollar, gold was at $850, an 8.5-fold gain. Then let's fast forward to the decade 2000 to 2010. The last time the US dollar was under internal assault. At the beginning of that decade, the gold price was $253. At the end of the decade, the gold price was $1,700, a 7-fold increase. Or, just for fun, let's lengthen the time frame. Let's do 2000 until today. At the beginning of the millennium, gold was at $253 an ounce. Now it's $2,600, $2,700. What's that, an 8-fold increase, 9-fold increase? Gold has done exactly what it was supposed to do for the last 24 years. It has maintained its purchasing power. If I'm right, and the decline in the purchasing power of the US dollar is at 7.5%, it was less earlier, and gold increased in value by 8% compounded over 24 years. What gold did is exactly what it was supposed to do. When people with a short-term orientation, the greed buyers of gold, say, I own it at 27 because I think it can go to 3,200. That number becomes real to them looking at the immediate past. That's not why I own gold. I own gold because I have a visceral memory of the decade of the 1970s when the gold price increased in real terms 8-fold. I own gold not because I hope it'll go to 3,200, but because I'm afraid it's going to go to 9,000 or 10,000. And Patrick, I would dearly love to be wrong.
Rick Rule's understanding of precious metals markets stems from decades of experience navigating the complexities of global finance. His insights provide a roadmap for understanding why assets like gold and silver continue to hold value amidst economic uncertainty. At the core of his argument is the recognition that gold and silver are not mere commodities. They are essential stores of value, particularly in times of inflation and geopolitical instability. Rule begins by addressing the elephant in the room, the declining purchasing power of fiat currencies, specifically the US dollar. While the dollar may perform well relative to other currencies, it is performing poorly in isolation. Treasury yields may seem enticing at 4.4%, but when adjusted for real inflation, closer to 7.5%, investors are effectively losing 3% of purchasing power annually. Over a decade, this amounts to a 35% guaranteed loss. This arithmetic alone underscores why hard assets like gold and silver are indispensable in preserving wealth. These metals don't just hedge against inflation, they provide a tangible, secure means to counterbalance the erosion of fiat currency value. Rule's analysis takes us through historical examples to illustrate gold's ability to maintain its purchasing power. During the 1970s, when the dollar lost 75% of its value, gold soared from $35 to $850, marking a nearly 30-fold increase. Even when stripping out the initial price surge from the legalization of gold ownership, the metal still delivered an impressive 8-fold gain over the decade. A similar trend occurred between 2000 and 2010 when gold rose from $253 to $1,700, and the story has continued into the present day. Since the start of the millennium, gold has increased nearly ninefold, demonstrating its consistent role as a safe haven. But Rule's perspective extends beyond gold. He also delves into silver's potential. Silver has a unique position in the market, bridging both industrial and monetary uses. While gold often takes center stage as a store of value, silver has a history of catching up and outperforming in terms of percentage gains during bull markets. Rule cites historical examples, such as the 1970s, when silver climbed from $1.20 to $50, in the 2000s, where it rallied from $5 to $50. These patterns underscore silver's explosive potential, especially as market leadership transitions from gold to silver during the later stages of a precious metals bull market. Moreover, the current economic environment is ripe for such a transition. Inflation remains persistently high, central banks are printing money at unprecedented rates, and geopolitical tensions are creating uncertainty across global markets. Against this backdrop, Rule suggests that the fear-driven demand for gold will likely set the stage for silver's breakout. Silver's lower price point and its role as a crucial component in industrial applications, such as solar panels and electronics, add layers of demand that gold cannot replicate. Rule's observations also highlight the importance of patience and strategic positioning. Precious metals markets, particularly silver, are notorious for their volatility. Yet it is this very volatility that creates opportunities for investors willing to endure short-term fluctuations for long-term gains. Rule emphasizes that silver's delayed but explosive price movements make it a compelling asset for those with the foresight to hold through the ups and downs. Beyond the numbers, Rule's message is fundamentally about safeguarding one's financial future. Precious metals provide stability in an increasingly unstable world. Whether you're looking to hedge against inflation, diversify your portfolio, or simply preserve your purchasing power, gold and silver offer time-tested solutions. As Rule notes, these metals have done exactly what they were supposed to do over the decades. They have held their value and even appreciated in response to economic crises and currency devaluations. The takeaway is clear. Investors must start thinking long-term. The window of opportunity to accumulate precious metals at reasonable prices is narrowing, and waiting for the perfect moment may mean missing out entirely. Whether it's gold or silver, these assets are not just investments. They are lifeboats in an ocean of financial uncertainty. For those paying attention, the time to act is now.
In my experience, history, I've been through, depending on how you count them, either 3 or 4 precious metals bull market cycles, some fairly short, but they followed a predictable pattern. The market was kicked off by a fear buyer buying physical gold. Gold moved first. After the momentum was established in physical gold, some of the better gold producers began to enjoy better profit margins. There's a delayed reaction to this, of course. But when that happened, the biggest gold producers began to move. And that momentum attracted generalist investors. When the generalist investor became interested in the precious metals narrative, a couple things happened. Going right to your question, perhaps because of the lower unit price of silver, leadership in the precious metals market changed from gold to silver. Silver moved later, but when it moved further and faster. Sorry to keep going back to history, but let's look again at the decade of the 1970s. At the beginning of the period, gold was at $35, price controlled. Silver was at $1.20 or $1.25. At the end of the decade, gold was at $850. Silver was at $50. Let's go back then to 2000. At 2000, gold was at $253. And if my memory serves me well, silver was at $5 or $6. At the end of the decade, gold was at $1,700 and silver was back at $50. When market leadership changes from gold to silver, silver runs further and faster. But it takes longer for it to get started. You may remember, or you may not, I looked at my notes of our last interview, yours and mine, or second to last interview, at the beginning of 2024. And I had suggested to you that the high-quality junior stocks as a whole were really, really, really hated. I love to triumph my past successes on those odd occasions where I was right, and I was really right. And I said, I think that these silver stocks are a coiled spring. Not because I think silver needs to do well over 2024, but rather because everybody who possibly wanted to sell these stocks has already done it. They're hated. And we've seen this weird circumstance in 2024 where the high-quality silver juniors are uniformly up 2, 3, 3.5 times, while the silver price hasn't moved much. So I would caution you that it may be that in the next stage of the silver bull market, in the beginning of the market, that silver itself, the metal, might outperform the junior stocks because the high quality juniors have already had such a spectacular run. Looking longer term, again, in my experience, Doug Casey famously points out that the market capitalization of high quality junior silvers is so small. And notice that I say high quality. I'm not talking about the really junky guys. When the generalist investor becomes interested in the space, there isn't enough room. There isn't enough market cap to contain the money. From the point of view of what silver bullion does, which is to say sells silver, you won't need me to tell you when leadership has transitioned from gold to silver. My experience is that when silver runs, you don't need a crystal ball to understand it's running. It really, really, really runs. Is that going to happen in 2025 or 2026? I don't know. What I do know is that when it runs, whether you had to wait 2 years or 3 years, doesn't matter much. You don't have to trust me on this. Just get a silver price chart going back to 1907 and take a look at what happens to the metal when it runs. It is truly, truly, truly astonishing.
Rick Rule's insights into the silver market underline the importance of both historical understanding and future anticipation. For the savvy investor, the silver market presents a unique blend of opportunities rooted in both its monetary and industrial applications. The often overlooked industrial demand for silver is quietly reshaping its market dynamics. Silver's essential role in solar panels, electronic devices, and even medical equipment has created a steady and growing demand that could soon overwhelm its limited supply. Rule highlights China's strategic acquisitions in Central and South America, where they've monopolized much of the silver production. Paying premiums even for unrefined ore, China's actions are a testament to the growing recognition of silver's critical importance. The average investor, however, remains largely oblivious to these developments. For now, silver's story is still flying under the radar. But as Rule emphasizes, this won't remain the case for long. When silver begins to break through key price levels, whether it's $35, $50, or beyond, it will capture public and institutional attention in a way that few other assets can. It's during this phase, when awareness spreads like wildfire, that silver's true potential is likely to be unleashed. Historical precedent suggests that this kind of market movement is not only possible, but probable. In the 1970s, gold's dramatic rise from $35 to $850 was mirrored by silver's leap from $1.20 to $50. Similarly, during the 2000 bull market, silver soared from $5 to $50, showcasing its explosive capabilities. Rule points out that silver's dual identity, as both a monetary hedge and an industrial metal, gives it a unique advantage. While gold is often seen purely as a store of value, silver's industrial applications provide an additional layer of demand. As the world increasingly prioritizes renewable energy, the need for silver in photovoltaic cells and other green technologies will only grow. This isn't just speculation, it's already happening. The green energy revolution, backed by aggressive government policies and corporate initiatives, is creating an unprecedented surge in demand for silver. The metal's vital role in solar panels and electric vehicles places it at the heart of a transformative global trend. However, it's not just industrial demand that will drive silver's rise. The macroeconomic environment is equally crucial. With inflation eroding the value of fiat currencies and central banks struggling to manage their balance sheets, the appeal of hard assets like silver becomes undeniable. The US dollar, while strong relative to other currencies, is losing purchasing power at an alarming rate. Rule's arithmetic is sobering. Even with a 4.4% yield on a 10-year treasury, real inflation adjusted for true purchasing power decline leaves investors losing nearly 3% annually. Over a decade, this translates to a guaranteed loss of 35% in real terms. In contrast, silver and gold offers a hedge against this erosion, preserving wealth in a way that paper assets simply cannot. Market sentiment will also play a pivotal role in silver's trajectory. As Rule observes, fear and uncertainty are powerful motivators. A significant stock market correction, rising geopolitical tensions, or escalating concerns about debt sustainability could all serve as catalysts for silver's breakout. Historically, these moments of crisis have driven investors towards safe haven assets like silver and gold. In the 2008 financial crisis, for instance, gold and silver initially faced a technical correction, but quickly rebounded, outperforming most traditional assets. Rule predicts a similar pattern will unfold in the next market downturn, with silver eventually taking center stage. The silver-to-gold ratio is another critical factor to consider. Historically, this ratio narrows during bull markets, signaling silver's outperformance relative to gold. Currently, the ratio remains elevated, suggesting that silver is significantly undervalued compared to gold. As this ratio adjusts, silver's price is likely to accelerate, creating a ripple effect that draws even more investors into the market. What's particularly compelling about silver is its accessibility. Its lower price point compared to gold makes it an attractive option for younger investors and those with smaller budgets. This democratization of investment could play a crucial role in silver's next bull run. As more people turn to silver as a hedge against inflation and currency devaluation, the influx of new buyers could create a powerful momentum that pushes prices to unprecedented levels. Rule also addresses the issue of market manipulation, a topic that often comes up in silver discussions. While manipulation may temporarily suppress prices, it ultimately sets the stage for dramatic moves. The pressure created by suppressed prices acts like a coiled spring, and when that spring is released, the resulting price surge can be extraordinary. History provides ample evidence of this phenomenon. In the 1970s, efforts to suppress gold prices through IMF sales ultimately failed, leading to an explosive rally. Rule sees a similar dynamic unfolding with silver. The current price suppression, while frustrating, is likely setting the stage for a monumental breakout. Investors, however, must approach the silver market with discipline and a long-term perspective. Rule emphasizes the importance of position sizing and emotional resilience. Overexposure can lead to panic selling during downturns, causing investors to miss out on the eventual upside. He advises a balanced approach where silver and gold serve as components of a diversified portfolio rather than all-encompassing bets. As the silver market prepares for its next phase, Rule remains optimistic about its potential. The convergence of industrial demand, macroeconomic pressures, and shifting market sentiment creates a perfect storm for silver's rise. But the window of opportunity won't remain open forever. Once silver starts to move, it will attract attention quickly, and much of the upside could be captured by early movers. Rule's message is clear: the time to act is now. By the time the broader public realizes silver's potential, the most significant gains may already be behind us. For those still on the fence, consider this: silver is not just an investment, it's a safeguard against uncertainty. In a world where fiat currencies are losing value and traditional financial systems face mounting challenges, silver offers a tangible, reliable store of wealth. Whether you're a seasoned investor or someone just starting to explore the world of precious metals, the case for silver has never been stronger. The question is, will you seize the opportunity before it's too late?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.